Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world to find the real story behind the numbers. Today we're diving into NFiniTi Incorporated's latest filing, a document that might seem dry, but trust me, it has got some juicy details about where this company is heading, especially after a big acquisition. NFiniTi Inc. filed an amended quarterly report for the period ending the 31st of July 2025. So, what is new and what does it mean for the company's future? Let's break it down. First up, let's look at the company's financial health right after this recent acquisition. On the asset side, they had around $24,000 in cash. That sounds small, but they also have a significant investment in something called a convertible note investment, over $195,000. Now, what is really interesting is the goodwill. This is an accounting term that represents the value of a business beyond its identifiable assets, often from a good reputation or strong customer base. NFiniTi is showing over $143 million in goodwill, which tells us that the acquisition they completed likely cost them a lot more than the tangible assets they bought. Total assets as of the 31st of July 2025 were about $143.6 million. Comparatively, on the 31st of October 2024, before this big acquisition, their total assets were listed as zero. You can clearly see the massive impact of the Artisan Beverages acquisition. On the liability side, they have about $14,000 in accounts payable, which are bills they owe to suppliers. They also owe almost $89,000 in related party payables. This means money owed to people who have a close relationship with the company, like officers or directors. We'll get more into that later. They also have loans payable, including about $158,000 from related parties and another $67,000 from unrelated sources. There is also a convertible note from an unrelated party for nearly $235,000. Their total current liabilities, meaning debts due within a year, are over $704,000. This is considerably higher than the roughly $156,000 they had in October of the previous year. Now, let's talk about the company's equity, or what the owners have. This is where things get really complex, especially with that acquisition. As of the 31st of July 2025, they list over 15.9 billion shares of common stock issued and outstanding. That is a mind-boggling number. They mention that this includes over 15.7 billion shares that are contingently issuable pending a rollback, which is essentially a reverse stock split. This means a huge chunk of their shares aren't officially out there yet. The additional paid-in capital, which is the money investors paid for stock above its par value, is over $127 million. This looks like a big number, reflecting the value brought in from the acquisition. However, they also have an accumulated deficit of over $318,000. This means that over time, the company has lost more money than it has made, which is common for early stage or rapidly growing companies. Putting it all together, their total stockholders' equity as of the 31st of July 2025 is over $142 million. Contrast that with the 31st of October 2024, where their equity was actually a negative $156,000. Again, the acquisition dramatically changed their financial picture. Moving on to the income statement, which shows how much money was made or lost. For the 3 months ending the 31st of July 2025, NFiniTi Inc. reported zero revenue. That is right, absolutely no sales. They did, however, incur operating expenses of around $73,000. These expenses were mainly professional fees. This is a significant jump from the mere $2,600 in expenses for the same period in the prior year, which is understandable given the recent acquisition activities. This resulted in a net operating loss of over $73,000 for the quarter. Looking at the 9-month period ending the 31st of July 2025, the story is similar, zero revenue again. Operating expenses were over $102,000, a big increase from about $18,000 in the previous year's comparative period. This leads to a net loss of over $102,000 for the 9 months, ending the 31st of July 2025. Now look at the weighted average number of common shares outstanding for the 3 and 9 month periods ending the 31st of July 2025. This number is over 15.7 billion. This reflects that massive number of shares issued as part of the acquisition deal. It's important to note that this is a huge number of shares, which can significantly dilute the value of each individual share if the company's overall value doesn't grow proportionally. Let's dive deeper into the changes in stockholders' deficit, particularly around the acquisition. As of the 31st of October 2024, the company had a negative equity of over $156,000. Then, on the 30th of April 2025, Following the acquisition, there was a massive issuance of shares. The common stock amount increased by over $15.9 million, and additional paid-in capital jumped by over $127 million. This is the financial imprint of acquiring Artisan Beverages. They also saw a net loss of over $73,000 in the quarter ending the 31st of July, 2025. So by the 31st of July 2025, their total stockholders' equity is over $142 million. Again, a massive shift from a deficit to a surplus due to the acquisition. Looking back at the prior year's 9-month period ending the 31st of July 2024, the company had a much smaller equity deficit, starting at negative $134,000 and ending at negative $156,000. This shows that before the acquisition, the company was operating on a much smaller scale with a different financial structure. Now let's look at the cash flow statement for the 9 months ending the 31st of July 2025. The company used over $7,000 in cash from its operating activities. This is after adjusting for their net loss. In investing activities, they spent over $195,000 to purchase a note. This is likely related to the convertible note mentioned earlier. Financing activities provided over $226,000 in cash. This likely comes from the loans and other financial arrangements related to the acquisition and ongoing operations. The net change in cash for the period was over $21,000, bringing their cash balance to about $24,000 at the end of the period. This confirms that while they secured financing, their actual cash on hand remains quite modest relative to their liabilities and the scale of their new business. So, what exactly is NFiniTi Inc? Now, the company was originally in the oil and gas business, but that changed dramatically. They completed a reverse acquisition of Artisan Beverages Inc. On the 13th of February 2025, Artisan Beverages is an alcoholic beverage company specializing in ready-to-drink cocktails. They even hold the license to manufacture TGI Fridays branded beverages for the Western Hemisphere. This acquisition is the main driver behind their current financial shape and strategic focus. Now, a critical point, the auditors have raised a going concern. This means it is not a sure thing that the company will be able to continue operating in the future. They've had limited operations and an accumulated deficit, while they believe their current cash is insufficient for the next 12 months. They are relying on loans from their president and shareholders for operating capital. Let's look at those convertible notes. They issued notes totaling $700,000 with a 50% original issue discount. This means they received only half of the principal amount as cash upfront. These notes carry a 15% interest rate, which can jump to 18% if certain default events happen. They are convertible into common stock at a discount. They also have another convertible note for $70,000 with the same discount structure. As of the 31st of July 2025, the carrying value of these notes shows over $200,000 and $35,000, indicating they are still outstanding and a significant liability. Related party transactions are also a big theme here. They owe Michael Noble, a director, money that is non-interest bearing. They also owe current CEO Brian Johnston a substantial amount, over $150,000, plus other management fees and expenses. Additionally, over $140,000 is owed to other shareholders who loaned money. This shows heavy reliance on internal or closely connected parties for funding. The stock structure is a key takeaway. They are authorized to issue 450 million shares of common stock, but they have issued over 15.9 billion shares. The difference between authorized and issued is massive. This is largely due to the acquisition where they agreed to issue over 15.7 billion shares. These shares are contingent on a reverse stock split or rollback. This means a huge number of shares are pending official issuance, and the timing and outcome of that reverse stock split are crucial. It's also noted that during the quarter, they found an overstatement of common stock related to pre-merger amounts. They reclassified $120,000 from common stock to additional paid-in capital. This didn't change their total equity, but tidied up the accounting for their stock structure. And what happened right after the reporting period ends? Well, the company issued a convertible note to an investor with payments made on the 30th of July 2025 and the 4th of August 2025. This shows continuous activity in securing financing, and in another subsequent event, it seems significant financing from Brian Winder, totaling $150,000, was completed on the 4th of August 2025. This reinforces the reliance on external funding. Looking at management's discussion and analysis, they reiterate that they generated no revenue for the periods discussed. Their operating expenses are primarily professional fees, and they project significant spending in fiscal 2025, including professional fees for reporting obligations, general administrative costs, and what they term working capital. totaling over $1.6 million. Interestingly, under controls and procedures, management concluded that their disclosure controls and procedures were not effective. This means they are not confident that information required to be disclosed is being recorded, processed, and reported correctly within the required timeframes. This is a significant red flag regarding the company's internal processes. On the legal front, the company states it is not involved in any material litigation. Finally, looking at the exhibits, we see the share exchange agreement for the acquisition of Artisan Beverages dated the 27th of January 2025, confirming the acquisition that is now the core of NFiniTi's business. So, what is the story here? NFiniTi Inc. has undergone a massive transformation through its acquisition of Artisan Beverages. The financials clearly show a company that was very small and struggling, now suddenly dealing with the complexities of a much larger, albeit pre-revenue, business. Their strategy is now centered on leveraging the TGI Fridays brand for ready drink cocktails. The sheer volume of shares issued and the contingent nature of a large portion of them raise a significant question about future dilution and shareholder value. The company's heavy reliance on loans, especially from related parties, and the auditor's going concern warning, coupled with ineffective disclosure controls, paint a picture of a company navigating a very challenging path. While the acquisition provides a new direction and a recognizable brand, turning that into profitable revenue and managing their debt and equity structure will be a monumental task. The opportunities lie in the brand recognition of TGI Fridays and expanding distribution, but the risks are substantial given their current financial state and operational inexperience in the beverage sector. It is a bold move, but one that comes with significant hurdles. Alright, that is our breakdown of NFini Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.